Do candlestick patterns really work? Do you use candlestick patterns? What is your experience? Leave your thoughts in the comments section below. A surprising fact about candlestick patterns is that they were first developed in Japan over 200 years ago. This ancient technique, which visually represents price action over a specific period, has since become a cornerstone of technical analysis. However, the question remains, do these patterns truly provide reliable insights into market movements? To answer this, it's essential to understand that candlestick patterns are not infallible predictors. They are tools, not guarantees. By the way, if you are looking for a reliable broker with very low deposit requirements and quick withdrawals, see the links in the description box below. Now that is out of the way, let's continue with our video. While candlesticks can offer valuable clues about potential price reversals or continuations, their effectiveness depends on several factors. 1. Context. Candlestick patterns must be analyzed within a broader market context. Factors such as overall trend, volume, and economic indicators can significantly influence their reliability. 2. Confirmation. A single candlestick pattern is often not enough to make a trading decision. It's generally recommended to seek confirmation from other technical indicators or fundamental analysis. 3. Individual interpretation. Traders may interpret candlestick patterns differently based on their experience, trading style, and risk tolerance. What one trader sees as a strong buy signal, another might view as a neutral indicator. That said, many traders and investors have found candlestick patterns to be a valuable aid in their decision-making process. They can help identify potential turning points in the market, gauge the strength of a trend, and understand the psychology behind price movements. One of the primary advantages of candlestick patterns is their visual appeal. The combination of colors, shadows, and bodies can provide a quick and intuitive understanding of market sentiment. Additionally, many patterns have well-established names and meanings, making them easy to learn and apply. However, it's crucial to recognize the limitations of candlestick patterns. They are based on historical price data and do not account for unforeseen events or changes in market dynamics. Over-reliance on patterns can lead to false signals and costly trading mistakes. In conclusion, candlestick patterns can be a valuable tool for traders and investors who approach them with a critical eye. While they do not offer guaranteed profits, they can provide valuable insights into market behavior and help inform trading decisions. However, it's essential to combine candlestick analysis with other techniques and to exercise caution when making trades based solely on patterns.